High yield ETFs can look incredibly appealing when you see those sky high distribution figures flashing on their websites. They make it seem like you're raking in profits every month. But have you ever really stopped to think, am I truly making money? Or is your capital just slowly evaporating while you're distracted by those flashy payouts? In this video, we're going to dive deep into some of the top high yield weekly paying ETFs and find out whether holding these funds for income is actually sustainable or if they're just burning your capital behind the scenes. To do this, we're going to break things down into two critical factors: NAV erosion or price erosion, and total return. First, we calculate NAV erosion, which tells us how much the fund's net asset value, or the fund's core value, has changed over time, excluding any dividends. This will show us whether the fund's actual value is moving up or down. If NAV erosion is negative, that means the fund is losing value, and that's a red flag, especially for income investors who rely on long term capital preservation. Next, we calculate total return, which takes both NAV changes and all dividends received into account. This gives us a clearer picture of how the investment has truly performed. Even if the NAV drops, the total return might still be positive if the dividends are big enough to compensate for the loss. To make it easier for you to interpret the results, we'll use a simple performance flag system. Green check means the total return is positive, which is the ideal scenario: you're making money and preserving your capital at the same time. Warning symbol means the investment has broken even. Not ideal, but you're not losing money either. Red cross means the investment has lost money overall, even after considering the dividends. This is a no-go zone. You never want to be in this situation. This structure will help us quickly identify which ETFs are actually building wealth and which ones are simply paying high income at the cost of eroding your capital. Now, whether the fund managers are just not managing their covered call strategies properly, or if you're stuck in a bad business, especially with single stock ETFs, this analysis tool serves as a buy or sell signal for most of these ETFs. So, let's get started. First on the list is ULTY, the YMAX Ultra Option Income Strategy ETF. This ETF is actively managed and aims to generate monthly income by using a portfolio of covered call strategies on US listed securities. Some of its current holdings include Robinhood Markets, Upstart Holdings, Tesla, ASTS, and AppLovin. ULTY was launched on February 28, 2024, but unfortunately, the exact initial offering price on that day isn't publicly disclosed. To work with what we have, we'll be using the first available price on Google Finance's chart as the starting NAV price for this scenario. Now, it's important to note that YieldMax typically starts all of their funds at $20 per share, with some moving to $50 later on. For this analysis, we'll round to the nearest $20 or $50 increment for each fund, and you're welcome to use any source you prefer. But this is what we'll use today. As at the time of this recording, ULTY has a start price of $20 and a current price of $6.28. It has had a total distribution since inception of about $13.21. This gives it a negative 68.6% on the NAV erosion score and a negative 2.552 on the total return score. The performance flag is a red cross, signaling that this is a bad investment and you most definitely are getting your own money back. It has failed both the NAV erosion test and distribution test since its inception. I will like to point out that depending on when you started investing in this fund, it could be a different result for you, but if you invested in day one, which is almost a year, you barely made any money. Next, we have YMAX, which is a popular choice among high-yield income investors. Let's dive in and see if YMAX can pass the test. Like many of the other YieldMax funds, YMAX started at $20 per share on its inception day. As of the time of this recording, the current price is $13.75. Now let's talk distributions. Since inception, YMAX has paid a total distribution of about $11.85 per share. When we analyze this using the NAV erosion scale, we can see that the NAV is down about 31%. However, when we look at the total return, we find that you'd be up around 27%, which is definitely a step in the right direction. Unlike ULTY, where you'd be losing money, YMAX hasn't completely failed. You're not in the red, and you're actually making some return on your investment. But here's the caveat. This isn't the ideal situation that would allow you to confidently say that these payouts are sustainable in the long run. While YMAX is a better performer compared to ULTY, it's still not the ideal scenario. So, while you're making money, you're not exactly in the safest zone. Keep that in mind when considering whether this is the right investment for you in the future. Next, we have YMAG, another popular choice among high-yield income investors. Let's see if YMAG can also pass the stress test. Like the others, YMAG started at $20 per share on its inception day. As of the time of this recording, the current price is $15.32. Now, let's look at the distributions. Since inception, YMAG has paid a total distribution of about $10.70 per share. When we check the NAV erosion scale, we can see that the NAV is down about 23%. However, when we calculate the total return, we find that you're up around 30%, which is a solid result. With YMAG, you're actually not doing poorly at all. It's certainly better than some of the others we've looked at so far. It would be interesting to see how both YMAX and YMAG perform after 5 years. Still, while you're not blowing up your account, this isn't the ideal situation either if you're looking for truly sustainable payouts. But hey, kudos to you. You're seeing positive returns, and that's definitely a step in the right direction. Keep an eye on it, and let's see how this one evolves in the long run. Next we have XDTE, the Roundhill S&P 500 DTE Covered Call Strategy ETF. This is another popular one among high-yield income investors. Let's see if XDTE can pass the test. XDTE started at $50 on inception day, and as of the time of this recording, the current price is $44.35. Now, let's look at the distributions. Since inception, XDTE has paid a total distribution of about $16.83 per share. On the NAV erosion scale, we can see that the NAV is down about 11%. However, when we look at the total return, we find that you're up around 22%, which is definitely a positive sign. With XDTE, we can see that while the NAV is eroding, it's happening at a much slower pace compared to most of the other ETFs we've seen. This is actually a good thing. Slower erosion means there's less risk of rapid losses, and it could indicate that this fund is managing its strategy a bit better. This one definitely stands out as one of the better ones I've seen so far. I'm not surprised given that it's running its strategy on the S&P 500, a much more stable index. It would be great to see how XDTE performs in the coming years, but for now it's definitely holding its own and showing some solid potential. Next we have YBTC, the Roundhill Bitcoin Covered Call Strategy ETF. This is another popular choice among high-yield income investors, so let's see if YBTC can pass the test. YBTC started at $50 on inception day, and at the time of this recording, its current price is $47.20. Now let's take a look at the distributions. Since inception, YBTC has paid a total distribution of about $32.76 per share. On the NAV erosion scale, we can see that the NAV is down by about 5%. But when we look at the total return, you're up about 59%, which is impressive. What's especially noteworthy about YBTC is that the NAV erosion is much slower than even XDTE, which is a great sign. Given that YBTC is running a strategy based on Bitcoin, one of the most volatile assets out there, this is even more impressive. This is definitely one to keep an eye on. It's holding its ground remarkably well, especially considering the volatility of the underlying asset. I'm curious to see how it holds up in the coming years, especially if we face a crypto bear market. For now, it's definitely a fund that's impressing me with its stability and growth. Now, I know I said at the beginning of this video that we were only going to focus on high-yield weekly income funds. But come on, what kind of high-yield income funds test would this be if we didn't put good old Misty to the test? So, backed by popular demand, we have MSTY, the YieldMax MSTR Option Income Strategy ETF, a fund that many people see as the godfather of high-yield income ETFs. Let's see if Misty can actually live up to the hype. MSTY launched at $20, and at the time of this recording, it's trading at $20.65. The total distributions paid out since inception come in at $39.60. So, what do these numbers tell us when we put them through the test? On the NAV erosion scale, Misty is up about 3.25%. That's exceptional, especially for a high volatility, single stock ETF running a covered call strategy on MicroStrategy, which is basically a Bitcoin proxy. Now, for the big number, total return, you'd be up about 200%. That's not just good, that's elite tier compared to other high-yield ETFs. In fact, Misty is not eroding like some of the other high-yield income ETFs. And that's what makes this fund so interesting. It's giving off strong income, has held up surprisingly well in terms of NAV, and has actually grown your capital in the process. Now the real question is, can it continue this performance in a prolonged crypto bear market? Time will tell. But for now, MSTY earns its crown as one of the strongest in this entire category. The main point of this video is to highlight just how important it is to really understand what you're investing in, especially when it comes to these high-yield income funds. On the surface, those fat weekly or monthly distributions might look like easy money. But as we've seen, the truth is often hiding beneath the surface in the form of NAV erosion and poor total return. It's not about chasing the highest yield. It's about sustainability, capital preservation, and making sure you're not just getting your own money handed back to you with a smile. I'd like to point out that while NAV erosion and total return are excellent starting points for evaluating these types of funds, they're just that, a starting point. They help us highlight the core issues of capital decay and overall performance, but on their own, they don't tell the full story. To really understand what you're getting into, you need to go a step further. That means combining those metrics with a few other key pieces: distribution analysis, personalized return calculations based on your actual buy-in price, tax implications depending on where you live, and an honest risk assessment of the fund's strategy. When it comes to ULTY specifically, the data is pretty clear. Unless you bought in at a much lower price and reinvested every distribution, there's a strong chance you've been losing money. So before jumping in or doubling down, take a step back and look at the full picture. If you found any value in this video, hit that like button, consider subscribing for more breakdowns like this, and drop your thoughts in the comments, especially if you're holding any of these funds. I want to hear your experience. Until next time.